Welcome everybody back to the weekly general update for the 13th of August, and it's been another really sensational week with lots to cover. I've already written a fair amount in the daily alerts this weekend, so I'll not go over all of that ground again, but certainly covering off on the key points. So first of all, just a reminder, this is general advice only. You need to make your own decisions with respect to your trading. So the action for the week, to summarise, the S&P 500 closed down 1.7% on the week, but look, honestly, it was all over the place, and from top to bottom there was a swing of 8.3%, which is absolutely huge. I mean, they're the sort of moves you expect to see in a month, not a week. For me, the key is Europe, as I spoke about on Thursday night. What happens there is going to be the key driver of where markets go in the short and medium term. By comparison, the ASX 200 closed 1.6% higher for the week, and that was really just a timing difference because we had a pretty big move down on Friday. And then the US didn't really have its big move down until Monday. So just a timing difference there between those two. Gold was about $80 higher on the week, or about 5%, so another major move for gold. But it really does look to be topping out to my eye at the moment, and we'll get either a few weeks or a few months of correction, and then it'll set up a wonderful opportunity because in my view gold is heading substantially higher. Silver's been underperforming to a degree. It was 2% higher on the week, and I think that difference at the moment is that gold is regarded as a real currency alternative to all the problems with paper currency, whereas silver has not really come back into that realm yet, but it will. If you look at history, silver always outperforms gold by a long way in a monetary crisis. So I would expect to see silver significantly outperform gold over the next 3 months, 6 months, 2 years, whatever time frame you want to look at. Copper had a big swing on the week as well, and finished down 2%, but recovered quite a bit of that ground. I think at one stage it was probably down about 7 or 8% also. So for me, the immediate future, and I wrote a bit about this in the alerts on the weekend, Europe is obviously going to remain the biggest problem. I think a huge market moving event is virtually inevitable. There are half a dozen of them that could occur, and obviously they'll be politically motivated, so they'll just be announced one day and we won't really know. But just don't be surprised to see one or several significant announcements that will really move the market a fair way. And I think the most likely event is that there will be some departures from the euro, whether it's countries like Greece that just decide that the austerity measures are all too hard and they decide to leave the euro, or alternatively you might get Germany or France decide that they're sick of propping up the peripheral countries, the smaller countries that don't have the same fiscal discipline, and we'll see one of those guys depart. And either of those eventualities are going to see substantial moves in the currency market. The euro, I think, will fall quite substantially, and that will mean that that will flow over then to all the other markets, bond markets, stock markets, and so expect a fair bit of volatility. The other possibility is that I know that they're trying to do this now, but I think there is virtually zero chance of it being successful, and that's to try and get a financial and political unification. So in other words, one of the problems of the euro is that you've got a central monetary system, but you've got completely different governments, you've got different different financial situations, you've got different cultures, and I can't understand how anyone in their wildest dreams could have ever imagined the euro would have worked with such a diversity. So I think there's a bit of a recognition of that, and talk at the moment about some kind of financial and political unification, but as I said, I can't see that it's going to happen. That's effectively asking a whole bunch of countries to give up their sovereignty, and that's not going to happen. So for me, I can't see any way out in Europe. I think it's going to get ugly, and that will cause great volatility on world markets. In the US, I think corporate results will continue to be okay because corporate America is doing certainly a lot better than their economy is. Eventually that'll catch up with them, but I don't think that's just yet. I also expect to see the riots like what we had in London. I also expect to see that move to places like the US because that was not an isolated local incident. That's coming about because of social pressures that have been building up now for several decades. And when you see unemployment rates of 20% plus across the board, and you see unemployment rates of 50% amongst young people in certain areas, you can understand that eventually something has to give, and we've got a similar situation in the US. So I expect to see some massive movements in the US dollar, mainly because of what's happening in Europe and also their own devaluations. I think QE3 is ultimately unavoidable for the US. It may not happen straight away, but it will happen. So the overall strategy, excuse me, the overall strategy is that I believe there is another down leg to come in the markets, and we'll have a look at the charts in a minute. As I spoke about on Thursday night, 1195 is the line in the sand, and if it either holds below that or manages to go above it, that will very much dictate the nature of the next leg down, whether it's a rapid move back down to where we were last week, or whether it's something milder that doesn't reach that level. We'll have to wait and see. Medium term, precious metals are going to be the place to be, desperately wanting to see a correction in gold and silver so that we can get on board at better entry prices and a safer entry price. I expect commodities to be volatile because currencies are going to move around a great deal, but because of the supply and demand situation, I expect currencies, whilst they will move around a lot, I think any downward moves will be short-lived and to net pretty much hold their ground where they are. Short selling the rallies, I believe, is a must. Otherwise, you are cutting off an enormous number of profit-making opportunities. Obviously, buying selected small caps on panic is going to be productive as well. And because of the volatility, we need to stay reasonably balanced between long and short, but with definitely a bias to the short side. So at the extremes, we'll be upping our exposure, but I'll be looking for certainly significant extremes, not every little lump and bump in the market to jump into. So we've seen over the last week that we've had a pretty good recovery already in the Australian market. We're already up about 300 points plus on the lows in just a week. So that's about 7 or 8% off the lows. So you can see if you can get into the market and take the opportunities on the extreme panic, as we saw last Tuesday, that you can do extremely well really quickly. So this is a market to be patient, wait for the extremes, grab them, make a quick profit, and you will be able to make a significant profit very quickly. So that'll make up for all the waiting, and then we'll get out of that position and sit and wait for the next one. It's the only way to play this market. If you want to be in there all the time, you are going to find it fairly difficult to make headway. So small exposure for most of the time, and then we'll hit it hard at the extremes, and then get back out again. That's the strategy. So let's have a look at the charts. This is the S&P on a monthly basis. So you can see we were having a fairly quiet correction through May, June and July, and then we're only a week into August and we've had this absolutely massive gyration. Now here was the key key line in the sand, 1101 was the first retracement level from the bottom in March of '09 to the top in April of this year. So 1101 was the key, and the price on the S&P got down to 1101.5. So within basically half a point of that. So that's technically absolutely spot on. So no surprise to see the market bounce, and it would be normal to see a little bit more up here, and then some more down, and then basically sideways, and the nature of it depends a fair bit on Europe. Let's zero in on the daily chart. So the daily chart, you can see we were massively oversold down here in the early part of last week, putting a retracement line from the top here in the 21st of July down to the bottom last Tuesday. We find that the retracement levels on the way back up again are 1195. So we got to a high of 1189 on Friday, but then closed off the highs. And then we've got 1223 and 1253. Now, if the market can close above this 1195 mark, then I think we'll probably see a move up towards, the 1250 area, and then we will get some kind of downward move, and it won't go there in a straight line. There'll be plenty of more minor ups and downs. But that would be the direction of the market in the short term. If it can close above 1195, I think we'd probably wind up some of our long positions a little bit more. And then we'll see some kind of sideways market, perhaps back down to the 1180 area. So fluctuating between there and 1250, and that how it does that will depend very, very heavily on Europe. However, if that doesn't occur and we don't close above 1195, then I think we'll see a fairly quick retest of these lows of last week, could even go lower. So 1195 is the area to watch over the next few days, see what the US can do in that area. Let's have a look at gold and silver. So gold, we can now raise this bar up here because we had a pretty significant high. We got to 1807. It actually got higher than that in the actual futures market. So the three areas to look for on the retracement of gold would be 1682, 1643, 1604 are the key areas for gold. So I'll be looking for evidence of a bit of support at those areas, and that'll be our buy-in zone. But as I showed on Thursday night, the price of gold has pretty much gone parabolic. You can see how closely it had tracked around the red 50-day moving average. Now it's gone way, way above it. That is unsustainable, and gold will have to work its way back towards this 50-day moving average. Let's have a look at silver. Silver looking for 3680 as a possible stopping area. We almost got there. We got down to 3702 on Tuesday night. So just looking for evidence of a bit of support for silver, and then that'll be our entry point. Let's have a look at copper. So this is copper on a weekly chart. You can see we had a big dip during the week. We actually got down under this $3.91 area. We actually got down to a low of 387, so just dipped a little bit under it, but managed to scramble back and close above the $4 level on Friday. So that was encouraging to see that. Now the ASX 200. This is it on a monthly chart. You can see we broke the lows of July and May. We got down to almost exactly this 61.8% level of the run that started in March of '09. 38.20 was the level. We actually hit a low of 37.65, so it actually dipped underneath that by a bit, but recovered pretty strongly. And we're back and closed the month, or at this stage the month hasn't finished, but we're at this stage on the same level as the lows of 2009. Let's zoom in onto a daily chart now. So taking a retracement of this run from the 22nd of July to the bottom, we've got retracement levels at 4091, which we broke, and then 4189, which we went above but closed below on Friday, and then 4288. So I would expect that we'll probably see this 4288 area, so we could have another 100 points of upside, which would also correspond to another 20-25 points on the S&P. So that all ties in pretty nicely. So really it's the S&P that's the key. However, as I outlined in the monthly session, I think there are some positives, and there are some reasons why the Australian underperformance over the last year or two might actually be set to turn around, and we might actually start to do a bit better than the US. And that's largely because I think the conditions are such that we could see more money coming back into the market that has been sitting on the sidelines in the US, and the trigger for that is really the Federal Reserve saying that they would hold interest rates at 0 for 2 years. That now gives a green light to the carry trade to resume. People can now basically borrow at extremely low interest rates in the States with confidence that interest rates aren't going to go up on them, and then they can move that money offshore into higher yielding areas such as the Australian dollar or the Australian stock market. So I think the game has changed with that Fed decision, and we're quite likely going to see more support for Aussie stocks. So that's it for this week. We've got I think a continuation of some volatility. What happens with the S&P around 1195 is critical. What happens in Europe with political decisions is critical. So we've just got to hold a lower exposure and just watch and wait. So talk to you next week. Cheers.